Okay, good morning. Good morning. I'm so sorry for the small delay, 2 minutes. We had some technical issues on this side, so apologies for that. A very good morning to all who have joined. It's fantastic to see some regular faces here. Okay, great. All right, I'm just allowing everyone to enter the room. Just bear with me. All right, so let's get this started. So welcome to another webinar titled, as you can see here, Profit and Risk Measures. For those of you unaware who is behind the mic, my name's Aaron Hill, and I'm one of the market analysts here at FP Markets. Now, for this webinar, I feel it should be a somewhat quicker session than previous presentations, as the subject is a little more defined, as I will be explaining some of the information a trader must, we must understand this when reading statement reports. And all brokers do send out on a monthly, quarterly, and annual basis, I believe. Do note that the slides are on the basic side of things for this session as well. So just bear with me. Okay. Right, so some may have likely been turned off by the title, I guess. I guess identifying the measures on one statement may not seem important or as exciting as smashing that home run on the chart. But in my opinion, these measures are very important. Understanding these values allows us to compare and evaluate standard measures of, system profitability and risk. So I must be clear that some of the measures I will talk about are not covered in your MetaTrader report, if that's the platform you trade with, while others are. So MT4 does actually allow you to generate a detailed report. I believe you simply right-click the account history tab and then select Save as a detailed report. But look, as usual, there should be no issue with sound or the slide deck, as these were double checked before I went live. So any issues with the sound or the visuals, please do let me know, and we'll see if we can get you up and running. It's fine to fire any questions you have during the presentation, but bear in mind, I'm not Isaac Newton, so any complicated maths may be best left to an email response where I can ensure I'm getting the correct information to you guys. Right, so let's move on. Disclaimer, as usual, the information contained in this material is intended for general advice only. Look, I'm not going to read through the whole passage, but what this really is saying in a nutshell is it's not investment advice. It is purely educational. All right, so agenda for today's presentation. We're going to be obviously looking to learn to read common profit measures. All right, so I'll take you through the important measures one by one that we need to understand when reviewing our statistics on our statements, and when you're also reviewing systems to possibly invest in. So if you're copy trading, if you're looking at getting into copy trading and you're looking at different providers, you want to understand these different measures. So with profit comes risk. Understand what risk measures are telling you. Look, I'll also do the same here regarding risk measures, so we'll go through them. And finally, Q&A. Look, for any questions I miss, it is here. I will try to get round to them. But look, as I say in all webinars, any questions missed or those that need a more detailed answer, email me and the research team at marketanalyst@fpmarkets.com. I believe that's in the chat box right now. And we'll get back to you. And please do send across any topics you wish us to cover in future webinars. So let's get this started. Nice and simple to begin with. Equity curve. This is the very basics that we should all understand. So an equity curve is this should come on all reports. So an equity curve is a level of equity in one's account over time. Ideally, we all want our equity curves to be a similar picture to this, so rising rather than falling. We do not want to be in negative equity. So you will see, let me just get the pen. or the spotlight, that will do. You will see that an equity curve does have drawdowns. So we have drawdowns within a rising equity curve, and this is perfectly natural. All the drawdowns are losses within a typical system. Now, losses should be expected, excuse me, and they will occur regardless of the system used. So this is a healthy equity curve. All right, so I have to get rid of this, I believe. Just bear with me. Something else some may not be aware of is an underwater curve. Now, an underwater curve, all it looks at is the strategy's performance from a different angle. What I mean by that is you're looking at displaying the drawdown seen following each successive higher peak in equity. So as you can see here, we have a peak in the equity curve and we have a subsequent drop. But as you can see here, the drawdown is displayed on your underwater curve. Now, an important point to be aware of this is the underwater curve, the blue area chart, is it's measured in percentage. So you can see here we have a 12%, maybe a 10% drop at this point here. So this equates to a 10% drop in equity. Here we have a 12% drop in equity from this peak down to this trough here. And this is where it gets a little bit hairy. We have a near 20% drop from the peak in equity at this point here. So the red is the equity curve, and the blue shaded area chart is the underwater curve. Pretty simple, I guess. If there's any questions, do fire away, and I'll happily clear any queries up. All right, number of trades. Look, I'm not going to spend too long on this. Number of trades is usually located within your trading statement. Is the number of trades you've taken, right? So the larger the sample of trades, the better. The larger the statistical sample of data we have, the smaller the deviation from reality. What I'm talking about there is if we're backtesting, so the larger the statistical data set we have, the smaller, as I said, the deviation from reality, which will be live trading. Initial deposit. The initial deposit, as its name implies, is simply the amount a trader deposits in his or her account to begin trading. This could be as low as $100 or as much as the trader feels comfortable with. Now, I'd always recommend traders, especially new traders, to begin with a small account size because it takes not a long time. It takes time to become accustomed to the risk involved in trading. So there's no point in us going for an average person going in with a $20,000 account, risking 2%. That's $400. And what this does is it puts you in a very uncomfortable position, and this is where emotions can really kick in. So we don't want to do that. We want to work our way up nicely. So think of it as a ladder. We're working our way up, understanding that we are risk managers first and foremost. All right, so common deposits, as far as I know, range between $1,000 to up to $10,000. However, I do know professional traders who trade much larger accounts. Now, gross profit and gross loss. So, gross profit is the result of all your profitable trades. So, if you had 30 trades and 15 were winning trades, the sum total of these profitable trades made would be 15. Of course, gross loss is simply the mirror opposite. It's the sum total of all your profitable trades. Now, from gross profit and gross loss, we can derive net profit. Now, net profit is the difference. Now, net profit will be on your MT4 or MT5 statements. So net profit is the difference between gross profit, the gross profit value, and the gross loss value. So as an example, if your gross profit is, say, 30,000 on the year, $30,000, and the gross loss was 20,000, well, come on, it's $10,000. 30,000 minus 20,000 gives us 10,000. Ideally, I shouldn't really need to say this, but we always want this value to be in the green, so positive values, meaning our profitable trades exceeded our losing trades. I believe many traders also refer to this as their bottom line. However, while having a strong bottom line is important, I must emphasize that it is equally important to understand what risks we are taking to achieve that bottom line. Now, as a simple example, if we are taking on excessive risk to achieve a bottom line profit, we have to ask ourselves how long before our account suffers a nasty drawdown or even account ruin. So we always have to, as I said, we are risk managers first and foremost. And this is something I encourage everyone to to understand regarding risk, especially if you're looking to copy trade or anything like that. When you're assessing the different providers, look at their risk, look at their drawdown. We'll go over drawdown very shortly, by the way. Okay, annualized rate of return. This is another key measure we have to acknowledge. We have to have knowledge of, which includes compounded interest. So here's the calculation. It's not that difficult. It really isn't. So the calculation, excuse me, guys. The calculation involves summing the starting account value, as you can see here, the initial account value, and by the gains or losses, and then dividing that by the initial account value. And then we raise this to an inverted number of years. So what we do is there is 1 divided by n, which is the number of years. So if you're looking at your annualized rate of return for 5 years, you would simply 1 divided by 5, and that would be 0.2, and you would minus 1, and you would get your annualized rate of return from that. So as a quick example, let's imagine we have a 4-year-old account, and we want to know the annualized rate of return for the system being used. So the let me write this in, actually. Just bear with me. See if I can. All right. So we have an account. So we have a 4-year-old account, 4-year-old account, and we are looking at. So the initial account value was, say, $20,000 US, and we gained 10,000 over those 4 years. Okay, over the 4 years of trade. Whoops, ignore the caps there. Over the 4 years. So the calculation to find the annualized rate of return is 20,000. I'll put 20K plus 10K, which is our gain, right? Which gives us 30K, which gives us 30K. And so with that in mind, we then have to divide that 30K. We have to divide that 30K by the initial, look at the formula, by the initial account value, which was 20K. And that will give us 1.5. So 1.5. All right, so with that 1.5, we then have to raise this. As you can see here, we have to raise this to the inverse power of 0.25 in this case, because 1 divided by n, which is the number of years, 1 divided by n, 1 divided by 0.25 is 1 divided by 4 equals 0.25. All right, so we have to then raise this to the power of 0.25. Most calculators have this function. And what that will do is it would give us let me just try and find the calculator to do this, actually. Just bear with me. Okay, no, I can't find the calculator. I can't get it on here, unfortunately. So look, 20K, 1.5, 1.5, and then raise that to the inverse power of 0.25. So we raise that to the power of inverse 2.5, and then we simply minus 1. We minus that value by 1. And then we should get around, because I did this calculation earlier, around 10.6% annualized rate of return. Now, feel free to do this in your own time. But yeah, 10.6%. So this means, what this means exactly, the annualized rate of return, our return was on average 10.6%. So what it does not mean is that we generated an exact return of 10.6% each year. It averaged, right? So one year may have been 6%, another year may have been 12%, and so on. So it's not an exact measure. It's an annualized, it's an average annualized rate of return. All right. So that's something to be aware of. And I don't believe this will be on your MT4 report, but there's something you can calculate if you have interest. Profit factor. Now, I do know that this is on your MT4 report. Now, profit factor is a cool profit measure, in my opinion. So while net profit actually involves taking the difference between the gross profit and gross loss, the profit factor is the ratio of gross profit to gross loss. So what we are doing here is dividing gross profit to gross loss. Now, profit factor is a metric that should always be above 1, or the strategy you are using is a loser. Ultimately, when I'm assessing or evaluating systems or portfolios, I'm always looking for a profit factor of 2 or more. And this is usually the first measure I take note of when analyzing a system's performance, be it live results or from a back test. So to give you an example, just off the cuff, imagine we see a profit factor of, say, 0.8. So in your, excuse my handwriting, but in your statements, you have a profit factor of 0.8. So if you're looking at, not in your statement, so imagine you're looking at a trader with a profit factor of 0.8, and you're looking at investing in his or her system. Now, if you invest 20K, so 20K multiplied by 0.8 gives you, I think, 16, right? 16,000. Is it 16,000? Yes, 16,000. So 16K. Now, that's not ideal, right? So we really want something, we really want a return on our money. So we always look for a profit factor above, above 1. Okay, we always look for a profit factor above 1. Now, say that we had a profit factor. So we looked at another system and that had a profit factor of 1.8. So we do the same calculation again, and this would give us a 36,000K return. So it's a good way of analyzing. It's a good starting point for looking at any system. So yes, any questions, please do fire away, and we'll cover that. No worries. Also, something I feel it's worth pointing out for newer traders present, and especially for those in the process of looking to invest their money in, say, a trading robot or something that guarantees to deliver an X amount of profit, look at the profit factor very closely. And excessively, I will say this, an excessively high profit factor is an alarm bell. So a profit factor of greater than 10, for example, echoes the possibility that the system you're about to purchase has possibly been curve fitted. Now, this is easily done. Curve fitting is easily done in using sample data and disregarding testing and outer sample data. And worryingly, this can fall. I know it can fall many unsuspecting clients who buy into those systems. So if you want any more advice, or not advice, but any more guidance on profit factor and things, do let me know through email, and I'll happily, or the team will happily get back to you on that. So there's another measure we can look at. I'm not sure this is on the MT4 statement. It's outlier adjusted profit to loss. I hope this is as its title implies. All the outlier adjusted profit to loss is a measure or adjusted for the largest profit, right? So the idea here is we do not want a strategy that relies on that one big win. Now, that's not to disregard any trend following systems, because I do understand that trend following systems, they take small losses, they take small wins, and then they wait for that 1 or 2 or 3 big wins or big trends. I understand that. So it's something you do need to take into account, especially if you're looking for a looking at a trend following based method. But if you're looking at different kind of strategies, this is something you want to take into account. So as I said, the idea is we don't want a strategy that relies on one big win. So without removing the largest profit, our profit factor could be high. So remember, our profit factor is found by dividing gross profit and gross loss. And we want it to be above 1 at least, preferably 2 or more. So look, if our strategy provides a profit factor of, say, 3, right? So imagine a system offering 30,000 gross profits and 10,000 gross loss, as an example. But when we remove that largest profit from the calculation, then the profit factor dips under 1. This could be a very troublesome system if we do not get that big win in the future, right? We would need to bring the system into we would need that huge win to bring the system into profit in the future. It's just not the risk I'm willing to take on that one big win, unless you're looking at that trend following systems with a good track record. Then I believe it's a different situation in that sense. So expected payoff. Now, I know for a fact this is on your MT4 end of month reports. This is actually at the very top, I believe, of the statement, generally under the gross loss value. Now, this is calculated by dividing net profit by the number of trades taken. So look, it's an average return from all closed positions. So let's imagine we take 100 trades. We take 100 trades in 1 month. You're a busy trader and you've taken 100 trades in the month and made a total net profit of $1,800. That means the expected payoff per trade is $18, right? So we divide 1,800, which is the net profit, and then we divide that by the number of trades. So 1,800 divided by 100 provides us $18. So that's the expected payoff per trade. Obviously, this metric must be greater than 0 for a positive expectancy in your system. Percent profitable. I won't go into too much detail here, but this is the percentage of profitable trades. So if we take the number of winning trades and divide it by the total number of trades we have taken, and then multiply the result by 100, we get the percentage of successful trades. The question is, to what extent is this a decisive indicator for us? The reason I say this is because there are strategies with only 30%, 35%, 40% profitability that are only 30 to 40% profitable. That have, let me rephrase that. There are strategies with only 30 or 40% trades that are profitable, but they generate much higher profits in the long run than, say, strategies with a 60% success rate. So there may even be strategies with 60% of the profitable trades that are actually losing in total. So the answer, therefore, lies in the average profit and the average loss for all trades and their ratio. So this is where the payoff ratio really comes into light. And this is another profit measure. So from memory, this is not shown on your average summary statements, but is certainly one to remember and can easily be calculated using your basic statement results listed under the average profit trade and loss. So the payoff ratio is, or the profit and loss ratio is your average profit per trade divided by the average loss per trade. So in simple words, the payoff ratio is the ratio between the size of the win and the loss. So between the size of the win and the size of the loss. So if we have higher values, obviously the performance is better. So let me just repeat this. It's basically a ratio that of the average winning trade to the average losing trade. Look, for me, I always want to see this above at least 1.5 to 2. So just as a very basic example, so that would be, so say our system had an average win of $400. So when we won $400 on average. And when we lost say $200 on average. So divide 400 by 200 to get 2. Obviously, again, the higher, the better. So if we had $600 win on average and a $200 loss, this would be 600 divided by 200, which would give us 3. What I don't want to see is so a $400 win on average and a $400 loss on average. We're trading a very difficult system there, I believe, because our payoff ratio is then 1. All right, so this is where it gets really interesting for me. Absolute, maximum, and relative drawdown. These are incredibly important risk measures and should be one of the first things you look at when you're assessing a system's performance. Right, so drawdown is essentially the maximum loss from an equity peak. So the loss from peak to trough. It can be expressed as the amount of money or percentage of the largest decline in capital in our historical trades or even our back tests. So look, as we may experience, we will over in our careers, we will experience large losing streaks. It's inevitable. And when we initially begin to trade, I believe I've read somewhere that the rule of thumb is to have at least twice the amount of capital seen in your maximum drawdown result. So the maximum drawdown result would be obtained from your backtest. So when you begin trading. So for example, if our maximum historical drawdown in a particular market was, say, 5K, we can say that our strategy requires an account with at least twice the drawdown value, so $10,000. On your MT4 report, you will notice 3 values. So we have absolute, maximum, and relative drawdown. Now I'm going to bring up this chart here. All right, so this is where our account began. All right, so this is where our account began. And the largest, so we're looking first at absolute drawdown. Let me get the pen out. We're looking at first at absolute drawdown. So absolute drawdown is from this point to this point. So it's the balance drop below the initial deposit, which was 5,000 to 4,000. So that would be 1,000 US. Just say this is US dollars, okay? Just to keep it nice and easy. So we have 1,000 absolute drawdown in this account as of right now. So the initial value was 5,000. The absolute drawdown, the drawdown below the initial account deposit was 1,000. So we have 1,000 absolute drawdown. Now, I'm not going to go into the percentages here, but the next one we have is the relative drawdown, that is. So the maximum drawdown is the next one. So the maximum drawdown in monetary terms was between, I think, yes, 8,000 here. And let's say this is 5,500. So 8,000 minus 5,500 is 2,500. Let me just put 2.5K. All right, so 2.5K. This is the difference. And I think this difference, when I was preparing this, I think the difference is around 31% in percentage terms. But so the maximum drawdown is the largest drop in monetary terms. So it's 2.5K. So this is your maximum drawdown, okay? It's not here, it's here because it's the largest drop. Okay, so finally we have a relative drawdown. Now, this is the largest balance drop in percentage terms between 2 points, so between an equity peak and an equity trough. Now, the relative drawdown, I believe, was, I think it was here, 6,000 to 4,000. which was around 33%. I do not believe it's here. It's here. So if we just do this quick calculation, 6,000 to 4,000. So an equity drop would be, so I always, when I'm calculating a percentage drop, I always use the ONO. So we have the initial, the older value, which is 6K. We multiply by the new value, which is 4K, which gives us 2K. Then we divide by the older value, which was 6K. So 2 divided by 6K. Let me just make sure of that. 2 divided by 6K. 33.3%. So yes, it's about right. So 33% rounded. Okay, so this was the largest from the equity peak at 6,000 to 4,000. We had a 33% drop. Now you're welcome to try and work out these, but in relative terms, in the for relative drawdown, this was the largest drop in percentage terms. So it would be from this point to that point. So that would be our maximum, our relative drawdown. All right. So absolute drawdown is 1,000. Relative drawdown is 33%. And the maximum drawdown is 2.5 or $2,500. All right. So just to quickly point out, look, a higher drawdown. So imagine this was, say, 4 or 5K drawdown. A higher drawdown means that there's higher chances of losing your total account. So when you're looking at someone's system, always look at the maximum drawdown, always look at the relative drawdown, always look at the absolute drawdown. Take these into account. So and a lower drawdown really means lower chances of losing your whole trading account. These are chances, guys. These are no guarantees, of course. So look, I will re-emphasize this point. To copy a trading account or while investing in a portfolio, the first step is to always check the drawdown of that portfolio. Professional traders do not look for higher profits, but they do look for minimum drawdown. All right, so. All right, long and short positions 1. This is on your MetaTrader statement. And this really is pretty self-explanatory, right? It's the percentage of long and short positions 1. So the number and percent, the percentage winners in long and short trades. It shows how good the system is when trading long and short the markets. You should observe if there is any asymmetry with long trades and look for possible reasons why. An example of this may be your method is better served as a long only strategy if your long positions prove more profitable than the short positions. And just quickly here, right, we have average profit per trade, average loss per trade, max consecutive wins, max consecutive losses. All right, so the average profit per trade is the average profit value for a trade. So the sum of profits divided by the amount of profitable trades. Average loss per trade is the average loss value for a trade. So it's the sum of losses divided by the amount of profitable trades. Max consecutive wins and max consecutive losses. Now, all this really is the longest series of profitable trade positions and the sum of their wins. And it's the same for losing positions. So the longest series of unprofitable trade positions and the sum of their losses. All right, 2 other profit measures I want to highlight, which you will not see on the basic reports, I believe, are the length of the average winning trade and the efficiency factor. Now, the length of the average winning trade, as you would think, is the length of the average winning trade to losing trade. Of course, we want to remain in winning trades longer than we do in losing trades. So we want the ratio to be at least above 1. So if our average winning trade is at, say, 11 days and our average losing trade falls over 11 days, also our ratio is 1. But the losing but the losing days step down to 8, so our ratio is then, so imagine our losing days step down to 8, as I just said. Our ratio is in around, I think it's around 1.37 ish. Now, this can be increased by using our length of average winning trades can be increased, of course, by cutting losing trading trades quicker and implementing things like trading stops. The efficiency factor is our net profit divided by gross profit. Net profit divided by gross profit. This shows how efficient, in the names in the title of the measure. So this shows how efficient our method is in that it demonstrates the percentage difference of net profit to gross profit. Look, the general rule of thumb is to have this fall within 38% to 69%. All right, so these are a little bit more complex, and I'm sure some of us may not fully be aware of these. So the MAR ratio, MAR ratio, or sometimes referred to as a recovery ratio. Now, this is the net profit percent as a ratio to the maximum drawdown in percent. Now, look, this ratio should always be above 1. So we're not really looking for our system to generate 10% net profit if we have a 12% maximum drawdown. This would give us a ratio of around 0.83. So we're looking for it to be above 1. This is why taking into account your maximum drawdown is very important. So what we're looking for is something like, say, 15% net profit with 8% drawdown, giving us a MAR ratio or a recovery ratio of around 1.9, 1.87, I think it was. So we're looking. So it's very important to always take into account your. I know I will keep repeating myself, but always take into account your maximum drawdown. Now, Sharpe ratio is a good one, and this is a performance measure that's widely used by industry professionals. So essentially what this is a ratio of excess return divided by the standard deviation. Now, this is a classic measurement allowing us to measure how much of a return we are getting when minused from the risk-free rate. Now, risk-free rate, think bonds here, for example. I think it's the 90, the T-bills, the 90-day T-bills, US Treasury bonds, T-bills in this case. So it's the excess return divided by the risk, which is the standard deviation. So standard deviation is a statistical measure of volatility. It shows us how much, for anyone that's looked at statistics, it really shows us how much variation or dispersion there is from the central tendency, the mean ratio. The mean value. So Sortino ratio is similar construction to the Sharpe ratio, but only one difference is the standard deviation. So whereas with the Sharpe ratio, standard deviation takes upside deviations and downside deviations. So you'll have the Gaussian distribution curve there, and what it does is it takes the deviation, negative deviation and the positive deviations. But with the Sortino ratio, it only takes into account the downside variance. So it only takes into account, so imagine I'm not going to draw it out, but yeah, so it takes into account the downside variance rather than both upside and downside, as we see in the Sharpe ratio. So I want to be clear, many do consider the Sortino ratio a better measure as it focuses on negative returns only. Let me just draw this in because I want it to be clear. All right, so we have you have to excuse my drawing here. We have our distribution curve here. So negative returns, positive returns. So with the Sharpe ratio, the standard deviation takes into account all of the positive returns and all of the negative returns. But with the Sortino ratio, it only takes into account the downside variance. So the negative returns, it ignores the upside variance. Okay, I hope that's clear. And that's why many do consider this to be a better ratio. And the reason for that really is, as investors, we don't really, I don't see any upside, the gains to be a risk. I see the negative returns to be the risk. That's where the risk is for me, the variance to the downside variance. And finally, we have the Sterling ratio. Now, the Sterling ratio is simply a simple moving average, I think, or arithmetic average of the annual net profit divided by our average maximum. I think it's maximum drawdown. I forgot, actually. I apologize. Sterling ratio, average maximum drawdown, I believe. I think that's what it is. But these are the three that I always pay attention to when assessing the systems. I don't really focus too much on that, hence why I cannot remember the full calculation. But I know it is I know it begins with the average annual net profit, and it's divided by, I think it's the average maximum drawdown, which would make sense. Right, so can I just clear these drawings and we move on? All right, so we're nearly to the end now, guys. Win-loss ratio and risk-reward ratio. Now, I'm sure you're all aware of these. Now, win-loss ratio, the ratio of the mean winner to mean loser, which are easily computed from basic data. So if you say you have 50 winning trades and 40 losing trades, well, the win-loss ratio is 1.25, right? If you have 40 winners and 20 losers, your ratio is 2. So it's very similar to the payoff ratio, right? Very similar. So for 40 winners and 20 losers, we win twice as much as we lose. We have twice as many winners as we do losers. All right, so risk reward ratio or reward to risk ratio. I know its name is commonly referred to as risk reward ratio. I'm sure you're all aware of this, but I see traders often confuse this ratio and compute it as their reward to risk. You will often see traders say my risk reward is say 2, but if we're taking a risk reward, this would mean they're risking say 1,000 to make 500 if you follow the risk reward ratio. But look, what they've done is simply calculated their risk reward. So let me just write this out. So I always look at it as reward. So I always look at it as reward to risk. So I'm looking for $1,000 US, say $1,000 US divided by my risk, which is say $500 US. I won't put the dollar there, but that equals what? That equals 2. So this is when you'll hear other traders say my R&R is 2. All right. So I think what they're referring to is this. So $1,000 US divided by $500 US, which gives us 2, right? If you have $2,000 divided by 500, your reward to risk ratio is then 4. All right. So this is what you should be looking in your trade. Do I consider this a very handy metric? I'm not too sure, because look, I know many do say that we should be looking at our reward to risk ratio when we're taking a trade. And I do agree, but we can never know how far the market is going to go in our favor. So I just don't see it's, yeah, I mean, as a way of assessing someone's a system's performance, yes, I can see the use. But on a chart, if we're looking to buy from support and we're looking at this resistance here, I suppose you could use it as that. And as long as it offers, say, at least a reward to risk of 2, I guess I can see that can complement a trade idea. But you never know if it's going to reach that resistance, and you don't even know if it's going to reach. It could even go, far beyond that R&R of 2. Could go up to 10, right? So it's very, very difficult. But as a way of assessing someone's system, yeah, I would probably look at the reward to risk ratio. All right, so that's it. So I don't see any questions. Either you're all asleep or you all understood this, which is fantastic. If there are any questions, do let me know. Remember, anything that requires detailed maths, I will reply it via email if that's okay. So look, we do have the webinars going forward. The webinars for the rest of this month. Just bear with me a minute. I'm just going to get up that list. Just bear with me. Sorry about this. Okay, so the next webinar for for us is on the 24th of November, and that's at 9 a.m. And this is more for stock trading and investing. And I'm going to be looking at growth versus value. So growth and value stocks, I'll try to define them, growth and value ETFs, and methods used to identify potential growth or value stock opportunities. As you can see, there is a link in the chat box where you can register for that. Yes, so other than this, as I said, there's no questions, which is, I hope, is a good thing. So look, that's pretty much all I have for you today. Thanks once again for taking the time to join. I hope you are able to walk away from this webinar slightly more informed than when you joined. Yes, and for any previous webinars you want to view, do consider clicking the links in the chat box. So this is where the recordings are. We also have a newsroom. We have a new newsroom, so that's on Telegram and Twitter. You can access the links in the chat box there, guys, and that will post market updates and all that good stuff. And we also have a trading academy. So this is where you can learn. This is especially for newer traders. This is designed for newer traders to come and learn and learn at your own pace as well. So it's the FP Markets Academy, and the link is in the chat box. So with that, have a great day, guys, and I'll see you all again very, very soon. Thank you so much.